Are you overcomplicating your finances in retirement? Or are you maybe making things too simple? That's the theme on today's Ask Me Anything episode, including some interesting new ideas I learned during my research about optimal portfolio rebalancing strategies. Stay tuned.
Welcome to Personal Finance for Long-Term Investors, where we believe Benjamin Franklin's advice that an investment in knowledge pays the best interest, both in finances and in your life. Every episode teaches you personal finance and long-term investing in simple terms. Now, here's your host, Jesse Kramer.
Welcome to Personal Finance for Long-Term Investors, episode 138. I'm Jesse Kramer. I'm a financial planner working with retirees and busy professionals thinking about retirement across the USA. You can learn more at planwithjesse.com. Yes, that's a new webpage for those avid listeners, planwithjesse.com. Today is our 16th AMA Ask Me Anything episode. Before we dive in, though, this week's Super Soft t-shirt winner is Growing the Valley Podcast, who left a 5-star rating and review on Apple Podcasts. So hey, Growing the Valley, thank you for the kind words. Please drop me an email to jesse@bestinterest.blog so I can get that Super Soft t-shirt sent out to you. Now, on with the Ask Me Anything episode. As a reminder, these are real questions from listeners just like you. So please don't hesitate to email me a question to the email address jesse@bestinterest.blog. Again, jesse@bestinterest.blog. I read every single email that you guys send. Now, a few questions I've gotten over recent months reminded me of the Einstein quote, "Everything should be as simple as possible, but no simpler." That's the theme of today's episode. I truly think financial planning and investing and retirement planning is usually often overcomplicated, especially in the DIYer world and the online forums where I'll see arguments erupt about 0.03% as a fee, or whether small cap value is a mandatory requirement in your portfolio or not. I've seen groups of people kind of plant themselves on topics like Social Security, where they say, hey, if you don't claim as early as possible, you're a moron. And they are opposed by people who plant themselves on the other side, who say, if you don't delay Social Security until you're 70, well, then you're a moron. So anyway, my point is that a lot of people have strong opinions strongly held, and sometimes there is complexity involved. But I do think something I see more often than not is over complexity. So yes, retirement has its complexities, but we can simplify it. At least we can simplify it to a certain point. Because, maybe there is 10 or 20% of the ideas that I hear where I feel like those ideas might be too simple or too easy. So anyway, the last thing I'll say in this preamble is I realize that, there's some subjectivity to this idea that I'm talking about today. And what I'm kind of saying is there's a line in between too complex and too simple. And I am subjectively drawing that line here today. Fair enough. I won't deny that fact. So if you think I've drawn the line in the wrong place, feel free to call me out by sending an email to jesse@bestinterest.blog. I'd love to read your email. And we're going to dive into question 1 right now from Wes. Wes says, Jesse, I appreciate the podcast and the blog content that goes beyond Personal Finance 101. Speaking of complex things, I have a question about generating investment losses to offset appreciated assets or the income from a Roth conversion. My advisor has been talking about a long-short strategy that I'm researching. However, I was thinking I could either short a stock I think will go up, risky, or simply buy a leveraged ETF, less risky, that is the inverse of the S&P 500. It seems like a simple strategy, but I don't see much content out there about this, so I'm guessing I'm missing some pitfalls. Can you give me some input? Hi, Wes. Yeah, thanks for the question. Very interesting question. Now, normally I would kind of dive into all the details behind your question first. I'm going to do it slightly out of order, listeners, in this question, but don't worry. You will get an understanding of exactly what Wes is asking here. But I'm going to paint a little picture first. Now, let's say you've invested money in the past and you've got $10,000 in capital gains, which you haven't realized yet. But when you do realize it, it will be subject to we'll say a 15% capital gains tax, so you'd owe $1,500 in tax. But then let's say you pursue a strategy, maybe similar to a strategy that Wes is outlining here, that creates $10,000 in capital losses. Those losses offset the entire gain, eliminates the tax, and you're thinking to yourself like, nice, you just eliminated $1,500 in tax. However, we kind of glossed over the fact that you just generated $10,000 in losses. So the $10,000 in losses totally wipe out the $10,000 in gains, and you no longer actually profited from your investment. The losses offset, wipe out the gains. So the question is, would you rather have $10,000 in gains and pay $1,500 in taxes, or have no gains whatsoever? I would take the first scenario every day. Why lose $10,000 to save $1,500? Now, what I've just painted there is a very, very simple scenario, and most of the strategies that professionals are going to use are certainly more nuanced and yes, more complex than what I've just outlined. Now, what they hope to do is create some losses and some gains. The losses are going to be realized. but the gains will be unrealized. In other words, the assets that are sitting at a loss, the professionals will sell those assets so that you, the investor, actually have losses that appear on your tax return. But the gains, they say, we're not going to sell those assets. We're going to hold on to them because the whole point here is that we want to wipe taxes away. We don't want to create more taxes for you, so we are not going to realize the gains, at least not yet. So your realized losses can be used to lower this year's tax bill, of course, which is nice. Those new unrealized gains, we kick them down the road to a future tax year. We don't have to pay taxes on the unrealized gains, at least not yet. So the question becomes, will we ever have to pay taxes on the unrealized gains? And that's why I think in some way, whenever we're talking about these kind of capital gains, capital loss strategies, if the problem involves kicking the gains down the road to a future year, that's fine. But the truth is you can't really ever outrun that tax problem except by dying. Yes, by dying. When you die, your taxable estate goes to your heirs at what's called a stepped up cost basis, and it totally wipes out the capital gains, and it totally wipes out what would have been your tax bill. And that brings about a little side note, brings about a funny little pattern in financial planning circles where we have to balance two competing ideas. The first idea is that everyone will die someday, and we must treat death as a reality, as an eventuality. But the second idea is that we need to be a little cautious about treating death as a win and treating living as a loss. And this scenario is one example. Sweet, you die with unrealized capital gains and your heirs get a big win. It's true, but you're still dead, and you didn't get to spend that money of yours while you were alive. Or another one, you claimed Social Security at 62, and that ended up being super smart for you because you died at 71, and age 71 is well before the break-even age for delaying Social Security, so it's a good thing you claimed early and got yours. Well, who are we talking to here? The dead 71-year-old? I mean, did they really win the game? Another one, oh man, Jesse, you're wasting $2,000 a year for 30 years on term life insurance. What a waste. Well, are you saying I failed because I'm surviving? So again, the point here is that death is a reality, an eventuality for all of us eventually. And I genuinely think there does come a time when, for example, we ought to prudently say, should we realize, capital gains for this ill, sick 87-year-old? Or do we discuss the idea of their death? Because for that person, if they're going to die soon, does it make sense to realize capital gains right now? Yeah, unfortunately, at some point, that conversation does become a reality. But I'll get emails from a 55-year-old who thinks they're going to kick the can down the road on their highly appreciated tech stocks until they die, 30 years out, 40 years out in the future. So anyway, a funny little aside there. Let's go back to the main program here about this capital gains, long, short strategy, that kind of thing. So short of dying, like we talked about though, what these sort of loss strategies attempt to do, again, is create some losses this year while not actually losing you money on net. Now, for example, Wes talks about a long-short strategy in his question. These long-short strategies, what exactly is going on here? Well, often what these strategies do is they use leverage, right? They use some form of borrowed money to give you extra investment exposure. It's a weird concept, but let me see if I can explain it. So let's say you have $100 to invest, but on top of that, you borrow another $100, and that's the leverage. And the leverage comes with a cost to it, right? Borrowing money, taking a loan, that has a cost. And so we'll put a pin in that cost for now. But you had 100 of your own dollars and you borrowed 100 more, so you now have $200 to invest. And you choose to invest 150 of that into the S&P 500. If you want to get more technical, you're probably building a direct index of the S&P 500 by owning all 500 companies. But either way, you have $100 invested in the S&P, and that's long, right? In investment world, when you're betting for something, that's considered long. When you're betting against something, that's considered a short, like the Big Short. So anyway, this is a long-short strategy. $150 is invested long in the S&P, and then you take the remaining $50 you have and you short the S&P 500. Yes, in some way you are betting against yourself. But on net though, you have $150 long and you have $50 short. So your net exposure is $100 long. In other words, you have the same investment exposure as if you had only invested your own $100 in the S&P 500, right? Even though you have that borrowed money, you're actually not taking any extra investment risk with it. You're not doing anything super risky. But you know that in most years, at least some part of your portfolio, between the $150 long and the $50 short, at least one of those two parts is going to be at a loss. Or if you went the direct indexing route, you know that some of your individual holdings, some of those individual companies are definitely going to lose money on an annual basis. So let's say some of your shorts lose money, you sell them. Those losses can then be used to offset other gains from your portfolio. They can be used to offset the taxes from Roth conversions, which would be an income tax or other forms of income tax. The point is that you can use your losses to offset taxes. And your advisor, Wes, would likely say, hey, and you didn't actually lose any money because your longs are up. The longs have these unrealized gains that more than make up for the shorts losing money. That's a totally factual statement. The question is, and I'll go into this in more detail, the question is, would you have been better off just being 100% long in the first place and not dealing with any of the losses in the first place? I'd wager, at least for a lot of people, the answer there is yes. So in my experience, the best strategies for using any sort of kind of capital losses to offset gains, it occurs when the losses are incidental, not when the losses are purposeful. And not all of us in our investing lifetime are going to have those incidental losses in our lives, let alone on an annual basis. And that's totally okay. In other words, what I'm saying here is, for some people, your portfolio will do nothing but go up, or at least it'll go up so much that by the time it goes down, you're still up. You're not below where you started because your portfolio has grown so much since the start. So if you find yourself in this situation, that's not a bad thing. Your portfolio is up. So sometimes you might get some incidental losses, and you can use those incidental losses to offset capital gains, to offset some income taxes. That's great. But one of the big questions I have is, should we let the tax tail, which might be a 15% tax tail, wag the investing dog, which is going to be 100% of the underlying money, right? The investments themselves. Now, direct indexing has all the same issues. This strategy, what I should say, a long-short direct indexing strategy, has all the same issues as all direct indexing strategies, which we discussed on episode 121. Those issues are higher costs, some tax pitfalls, especially when it comes to the wash sale rule, tracking error against the index, diminishing benefits over time, higher asset minimums. Only relatively wealthy people can even begin to participate in these strategies. And then it only applies to taxable accounts here, right? None of this applies to retirement accounts because those are all qualified in the first place. There aren't capital gains, there aren't capital losses inside of a retirement account. But the diminishing benefit over time is a really big one, Wes, that I want to focus on. A lot of these strategies require forever maintenance because if you recall, you're not really making the capital gains totally disappear. When your direct index, if one side of your long-short portfolio is kicking off losses, the other side is creating unrealized gains. And so to liquidate this direct index long-short portfolio, you would have to realize all those gains. And that flies in the face of what you're trying to accomplish in the first place. Who would do that? So what ends up happening is you're going to have to maintain this strategy for a long time. But the costs of a direct index portfolio or the costs of a long-short portfolio where there's some leverage, those costs will still be there for a long time. So if you're choosing to pursue one of these strategies, I think it's important to look at what your tax savings might be, this year, next year, and other high tax years. Totally important to look at that. And it's important to see how much in losses your portfolio is going to generate, because as long as markets generally go up over time, the fact is you will have fewer and fewer losses as time goes on. We call that loss decay or tax alpha decay. And then you're going to need to measure against that how much in direct index fees you'll expect to pay, not just this year, not just next year, but for decades. And it probably does feel amazing. It is amazing that an investor who pursues this strategy might get 3% or 4% in tax alpha or an extra performance that comes from saving so much money on taxes. But eventually that tax alpha will drop to zero, and the fund is no longer creating any sort of meaningful losses for you to use. And even if it was, you might not be in a tax situation anymore to use those losses, but you're still paying 0.5%, 0.75%, 1% per year. And so the tax alpha that you got when you first started the strategy is slowly getting eaten away by the much higher than normal fees that you're paying. And the people who use this strategy, quote unquote, the best candidates for this strategy, I should say, are not, the late 60s retirees. They're people in their 40s and 50s. They're the higher earners in the best years of their careers. They're getting paid maybe an equity compensation from a publicly traded company. These are the people who might have to hold that direct index long-short strategy for 40 or 50 more years, lest they want to realize all the capital gains that they avoided in the first place. But holding the strategy for 30 or 40 or 50 years, as I just identified, has its own big problems. So in summary, I have some serious reservations about this strategy. And I think for the vast majority of people out there, including many of the wealthier people who might be listening right now, I'd be cautious here. As Einstein said, this is not as simple as possible. Thank you for the question, Wes. Here's a quick ad, and then we'll get back to the show. I love getting your questions, and some of you ask me questions about the wealth management firm I work for in Rochester, New York. Others ask about the Best Interest blog and this podcast, Personal Finance for Long-Term Investors, which operate without advertising, without pushy sales, and with no paywalls. How can the blog and podcast stay afloat without me dumping my own money into it? Well, to answer both those questions, I want to point you to episode 78 of Personal Finance for Long-Term Investors. I intentionally recorded episode 78 to shine light on those topics and inform you how you are actually helping and can continue helping these projects carry forward. So if you've ever been curious about the business of my blog and podcast, or if you're curious about my day job in wealth management, please check out episode 78 and let me know what you think. And now on to question 2 from Cliff. As I get closer to my retirement, I wonder how long my retirement savings will last. My wife has some of her IRA with a trusted broker who is suggesting a 5% withdrawal rate. She asked how long it will last, and he said likely forever, because it should return 8% on average, and we would only be taking 5%. Do you agree with this? Cliff, thanks for the question, and I believe the explanation that this broker suggested to your wife is on the too simple side of things. It is too simple. After all, if we use the broker's logic, if it's returning 8% on average, why can't your wife withdraw 7.9% per year? I think the same logic ought to apply, right? 7.9 is less than 8, and that should probably last forever too. So there's a problem there. Let me try to add a little bit of nuance to what the broker said. I think what the broker should have said is, history would suggest that your portfolio will return 8% per year on average, and therefore most of the time, you could easily withdraw 5% per year, maybe even a little more, and be totally fine. However, this simple framework overlooks a really important fact, which is that the earliest years of your retirement matter the most by far. If the early years have very bad investment returns for you, it creates this chain reaction that affects the rest of your retirement timeline. We call this the sequence of returns risk. And in order to mitigate that risk, we recommend planning your withdrawal rate in the 4 to 5% range, at least to start, and then we can revisit that withdrawal rate over time. Now, that's obviously a longer, more complex statement than what the broker said, but if the broker had said something like that, I think it would have been much closer to the truth. If you look at how the 4% rule was originally created, what you see is that in more than 50% of historical scenarios, we actually could have withdrawn more than 6% per year. We could have used a 6% rule adjusted up for inflation every year and been totally safe. In fact, in some scenarios, you could have withdrawn more than 8% per year and been totally safe. But in the worst scenario, in the back testing, you could only withdraw 3.9% per year to avoid depleting your portfolio. And again, that's with all the 4% rule, Trinity study assumptions of a 50-50 portfolio, and et cetera, et cetera. We won't get into all those details on this episode. The point is that we draw the line at 4% because in one of the 100 back tests, 3.9% was the place where it failed. So that's why we draw the line at 4%. And I think the question is, should you let that one worst case scenario define your retirement? And one of the big problems is just that there's so much luck of the draw, right? Someone who retired in the early 1980s, and if you're not, a student of market history, a big bear market and kind of the stagflation-y 70s, which were really bad, that really ended in about 1982. Starting in 1982 was what some people consider, and kind of, if you look at the numbers, might be the best bull market of all time. 1982 through 1999, stopped by the internet bubble. And you could also point to maybe like March of 2009 through today as being another one of the greatest bull markets of all time. Anyway, if you retired in the early 1980s, you could have lived your entire 30-year retirement withdrawing more than 8% per year, adjusted each year for inflation, right? They could have retired. And think about that. The 4% rule means you have to save 25x your portfolio. Well, this particular retiree who retired in the early 80s, they could spend more than 8% per year. They could have retired with only 12 times their annual spending saved in their portfolio. They don't need 25x, they only needed 12x. But someone in the same circumstances retiring in the mid-60s, they, as I mentioned before, that was the worst case scenario. They could have only withdrawn 3.9% per year and would have needed the full 25 times their annual spending to retire. And that's a massive difference in how much you need to save to retire. And it's solely due to, in this case, the good or bad luck of timing. So here's my personal recommendation or personal solution for how to think about this problem. I think you can use the true 4% rule as a starting point, but only a starting point, because that 4% rule creates a conservative bookend that kind of limits one side of what your retirement might look like. If you want an easy, but admittedly still flawed rule of thumb to be a little more optimistic, it's that a 5% withdrawal rate has been safe in most historical scenarios, that a 6% withdrawal rate has been safe for about half of historical scenarios. And obviously, your specifics matter a lot here. And I think if you're willing to be flexible, specifically by decreasing your spending during poor market periods, then you're probably going to avoid many of the bad outcomes that come from higher withdrawal rates. When you hear about the 4% rule, the 5% rule, the 6% rule, when you hear people like me describing them to you on a podcast, that particular retiree in the simulation, so to speak, never adjusted their spending once, right? There are people, and there were investment markets where the market was down 30%, their portfolio was down, whatever. If they're half invested in stocks, their portfolio might have been down 15 or 20%. Maybe they lived through the dot-com bubble. Maybe they lived through the great financial crisis. Their stock side of their portfolio was down 50%, and they never once adjusted their spending. Now, that's probably not realistic, right? Most of us are going to adjust your spending. So that's why I say, if you're willing to be flexible, specifically by decreasing your spending during poor market periods, you'll surely avoid many of the adverse outcomes that come from higher withdrawal rates. And then ultimately, if you want precision, which many people do, then your unique retirement attributes, and really what I think about here is your unique kind of spending profile over your retirement, has to be used to hone in on a better answer for you. So again, because the 4% rule is kind of based on some really rigid inputs that went in to create it, we need to add some flexibility to those inputs. So what I think we should do there is you should say, what exactly does safely spend mean to you? How will your spending change from year to year throughout your retirement? How is your portfolio allocated among different assets? Because the 4% rule is just 50% stocks, 50% bonds. How long will your retirement last? The 4% rule is based on a 30-year retirement. Maybe your retirement's going to be different. What does inflation look like during your retirement period? I realize it's impossible to know, but inflationary assumptions are extremely important for any kind of projection, retirement projection, especially over multiple decades. And then, of course, what will investment returns look like during your retirement? Again, impossible to know in advance, but what is very easy to find out, and what I think we all need to find out, is basically if I spin the dial, if I dial up or dial down inflation, if I dial up or dial down investment returns, how does that affect my results? And that's where some analytical retirement tools can do a lot of heavy lifting. So what I've described here certainly isn't easier or simpler than what Cliff's wife's broker said. It's much more nuanced than what Cliff's wife's broker said. But I think it's important that we understand that not everything can be simplified all the way down to, hey, so easy that a third grader can do it. So thank you, Cliff. Good question. I appreciate you writing in. And now Q3 is from Lucy. Lucy says, we're both 60 years old and looking to retire soon. My husband has been sending me some articles that really push for both of us to claim Social Security as early as possible due to future Social Security liquidity concerns. Can you play devil's advocate against his idea? Lucy, I would love to be the person, I'd love to be the man who argues against your husband. That's definitely a role that I want. You know what? Just call me up anytime you want. If you want to prove him wrong, I'm sure he's going to understand, and he'll just play along nicely. Hey, a strange guy on the internet with a podcast is telling me how I'm wrong? No, I'm kidding, Lucy. I'm happy to help. And I hope I add enough nuance here to, maybe just expose your husband to some interesting ideas that he hadn't thought about before. Let's first discuss the liquidity or viability of Social Security itself, and then we'll talk about the good, better, and best Social Security claiming strategies. So yeah, will Social Security still be there when you need it to be? Many of you might have seen or heard that the Social Security Trust Fund could be depleted sometime in the mid-2030s. And to many people, that sounds like the system is about to break apart and probably will stop paying benefits. But that is not the truth, and that's far, far, far from what the projections actually say. So when the trust fund reserves are depleted, again, 2033, 2034, 2035, Social Security will still be there. What's going to happen, though, is that incoming payroll taxes are going to fund most of the benefits. And that's actually what's going on today. It's just that most of us don't realize it. Every working person, right, pays Social Security taxes every year, and those taxes currently support something like 80% of all the Social Security outflows. The trust fund, which is going to run out eventually, the trust fund covers the remaining 20%. So if the trust fund went away today, the current Social Security taxes that we are all paying would make retirees about 80% whole. Now, that's not a good outcome, obviously. We don't want that. We shouldn't accept that. We want to make everybody 100% whole. But what I just described, being 80% whole, is far different than saying that your Social Security benefit is going to zero. If you'd rather have a story that deals with numbers, think of this. 70 million Americans collect Social Security benefits today. And looking at the population distribution by age, Those numbers are pretty unlikely to change over the next 10 years. So again, 70 million people will be collecting Social Security roughly by the mid-2030s. All of them are voters, right? They're over the age of 18. And if you tell 70 million people that their income is going to get cut either by $2,000 a month if the system just totally disappears, or by even $400 a month, which would be if the benefit cut gets cut down to the 80% number, those 70 million people are not going to like that outcome. And so where there's a will, there's a way. And I would bet that the retired electorate has a will to not let Social Security benefits get cut. Now, according to projections from the Social Security Administration, closing the gap could be achieved with a bunch of different policy changes, increasing payroll taxes, which wouldn't be fun, raising or eliminating the taxable wage cap. That's an interesting one. You might know that only the first $180,000 of someone's earned income is subject to Social Security tax. You know, Warren Buffett, who you know I'm a fanboy of, he'd love to call out the BS on this fact because he paid the same amount of Social Security tax each year, which was about $10,000 on the $180,000. So, you know, Warren Buffett is paying $10,000 a year in Social Security taxes, and so was his secretary, right? Every dollar that Warren Buffett earned over $180,000 in a year is not subject to Social Security tax. So if they raise that cap, it's an additional tax basically on the highest income earners for sure. But yeah, it would help close that gap. Other policy changes, they could gradually adjust benefits. I think this is possible and likely. They could increase the retirement age modestly. I think that is also quite possible and likely. And I think there's a unique take that I haven't really heard mentioned very often. They could actually lower the retirement age below 62, but then pair that with a relatively severe throttling of the benefits themselves. You know, right now you might know that collecting at age 62 gives you 70% of your full retirement benefit. Or in other words, you take a 30% haircut for life if you choose to collect Social Security at age 62. Well, what if they allowed you to collect at age 60 with a 50% haircut for life? Or whatever the numbers have to be. Because again, putting myself in the shoes of an actuary, we need to do something that lessens the overall stress to the Social Security system. And there is a way to say, yeah, we'll let you collect early, but we'll give you such a big haircut that actually it ends up being better for the system overall. And none of those changes require dismantling the system. So Lucy, I think it's fair to share those ideas with your husband. It's very unlikely that Social Security will be going away. And now that brings us to the optimal time to collect. Let's start with something obvious and simple, but pretty important. If you knew exactly when you and your spouse were going to die, then you could precisely pick your best, most ideal Social Security claiming dates. And of course, you don't know that, but I think it's important to make the most educated guess that we can, because when it comes to an optimal strategy, what we have to do here is say, well, the probabilities suggest that we are going to die at ages A and B, and therefore we should claim our Social Security in this way. Social Security uses this concept called full retirement age, FRA, full retirement age, to determine how much of your eligible benefit you will get to collect. Your personal full retirement age depends on the year you were born. For most of, well, I shouldn't say for most, for all of today's retirees, it's either 67 or 66, or maybe 66 in a certain number of months. As I just alluded to, you can start collecting at age 62, which is before your full retirement age, but there's a price to pay and your benefits will be permanently reduced. But then if you wait to collect until after your full retirement age, then your benefits will be permanently increased. Now, if there's just one person involved, so there's not a spouse involved just yet, if there's just one person involved and all you have to think about is your own benefit, then the pure logic and the pure math is pretty straightforward. It basically says if you die before age 77, then collecting as early as possible would have been best. But again, we have to go back to earlier where it's like, well, if you die early, is that really a win? I know. But pure math and logic says if you die before age 77, you will have wished you started collecting Social Security at age 62. If you die between ages like 78 and 80, early 80s, then all the scenarios, all the ages are roughly equal. And then really, if you die after age 80, especially it becomes really clear if you die like after age 82, then having waited until age 70 to start collecting will have been best in hindsight, right? I think this makes sense because your benefit goes up if you wait to collect till 70, and therefore the longer you live after age 70, the more likely that is to have turned out to have been a smart decision. But there is much more to consider here, and I think to get to the real meat of the answer, what are some applicable strategies, thought processes, if-then scenarios that can guide you and your family in Social Security decisions? The poker player Annie Duke, she'd like to say that two things determine the outcomes in your life. Thing one is the quality of your decisions, and thing two is luck. So put another way, there are some things in your control and some things out of your control. And so whatever decision you make regarding Social Security, you have to accept that luck might strike and your decision won't have been the optimum one. And it's not because you made a bad decision, it's just because of luck. Even though bad luck might screw you over, you still want to make a high quality decision if you can. You want to try to get this right. So let me start with this. Social Security is pretty close to a one-way decision that you cannot undo. But the exception to that is that once you start collecting Social Security, you do technically have up to 12 months to change your mind. And if you do change your mind, then you have to repay any of the benefits that you'd received so far. They call that a withdrawal. And you get one of those withdrawals in your lifetime. A little known fact, you can undo your decision to start claiming Social Security. But once you delay Social Security, right, you can never go back in time and reclaim your missed benefits. You can't be 67 years old, having never claimed, and say, actually, I want to retroactively go back to 63 and start collecting. So ideally, that's why you want to get this decision right. In a perfect world, you get it right the first time. So let's think about you and your spouse. Spousal benefits and survivor benefits, two different things, spousal benefits and survivor benefits. Many rabbit holes in Social Security planning, and spousal and survivor benefits are two of those rabbit holes. And I mean rabbit holes because there are many paths and they go pretty deep and it's easy to get lost. The upshot for basic Social Security planning is that your decision to collect Social Security not only affects you, but it could affect your current spouse, it could affect your ex-spouse, and or it could affect your future spouse or your future widow. So basically, it doesn't matter who you're married to now, who you were married to in the past, or who you might be married to in the future. Your decision to collect Social Security is likely going to affect them. So let's say Bob has a primary insurance amount of $3,200 a month. Again, that primary insurance amount, that represents what Bob would have collected if he collects at his full retirement age. So if he collects early, it's going to be less than $3,200 a month. If he collects late, it's going to be more than $3,200 a month. But we'll say Bob's primary insurance amount is $3,200 a month. Bob's married to Sharon. Her PIA is $1,200 a month. And let's say, to make this simple, they both opt to start collecting at full retirement age, and thus they're collecting exactly 100% of the PIA numbers we just described. $3,200 for Bob, $1,200 for Sharon. Well, right off the bat, Sharon will be collecting something called a spousal benefit. Now, why? It's because Sharon's benefit, $1,200, is less than half of Bob's. Bob's is $3,200. Half of $3,200 is $1,600. So Sharon's $1,200 is less than half of Bob's. So she is eligible for 50% of Bob's PIA, or $1,600 a month. So she's going to collect her own $1,200 benefit, and then she's going to get an additional $400 a month at no sort of penalty to Bob at all. There's no penalties involved. No one is losing any benefits here. It's just that as a spouse, you are eligible for 50% of your spouse's PIA. And yes, Sharon is collecting this while she's alive and while Bob is alive. This is the spousal benefit. And the ages that Sharon and Bob choose to collect Social Security, again, if they had chosen to collect early, if they had chosen to collect late, those decisions do affect what the spousal benefit looks like. So it's important to know that. Now, what if Bob dies? Well, notably, if Bob dies, Sharon is going to step up into Bob's full benefit, receiving the full $3,200 a month that Bob was receiving. Sharon's own benefit would drop away. However, if Bob had started collecting early at age 62, his benefit would have only been about $2,300 a month. And after Bob died, Sharon would step into that $2,300 per month benefit. And if Bob had started collecting, say, at age 70, his benefit actually would have been about $4,000 a month. And Sharon would have stepped into that $4,000 a month benefit when Bob died. So the point is that Bob's decision to collect at 67 and collect $3,200 a month, it didn't only affect his benefit while he lived. It also had these side effects on Sharon's benefits, both while they were alive and after Bob died. So the point is, again, that spouses need careful consideration when deciding when to claim Social Security. They need to consider various scenarios for which spouse dies first and at which ages. So some rules of thumb for you when it comes to these spousal and survivor benefits. Again, it's a spousal benefit when they're both alive and Sharon was collecting half of Bob's benefit. It becomes a survivor benefit once Bob died, and then Sharon steps into Bob's full benefit. So some rules of thumb here that apply in a lot of cases, maybe not every case, but apply in a lot of cases, is that the lesser earning spouse, so in this case, Sharon, the lesser earning spouse can often start collecting Social Security as early as possible, but that the higher earning spouse should delay Social Security as long as possible to age 70, because again, their decision to do so has a 100% chance of affecting their own benefit, but then also has a roughly 50% chance of affecting their spouse's eventual benefit. With, the Sharon and Bob scenario being a perfect example. If Bob had waited till 70, his own benefit would have been higher while he was alive, and also Sharon's benefit would have been higher after Bob died. Now, I think it's okay, too, to dig into the probabilities of who dies first, to think of health, illness, family history, that kind of thing. The most common questions that you can ask yourself surrounding your kind of a married couple decision to collect Social Security revolve around your personal health and family history. You should ask, does anything there in your personal or family history point to either an early or a late death? If you're healthy and all your relatives live to 100, it's reasonable to assume that you might have a similar fate. If you're chronically ill and your relatives have all passed away early, again, you could reasonably assume that you might have a similar fate. Certainly not a doctor here, but the idea is that they say genetics load the gun and environment pull the trigger. The idea is, you aren't condemned to your family history. You do have dials to control. Don't forget that. But it's worth understanding what either your family history or your personal health history looks like. Next, I would ask yourself, do you really need to take Social Security early? Like truly, do you have a financial need to take it early? Because if that extra income is going to bridge the gap between cat food and a normal human diet, well, maybe you have to take it early. But if you don't need it, why are you taking it early? Delaying Social Security acts as longevity insurance. In fact, the full name of the Social Security program for retirees has longevity insurance right there in the name. So protecting against the risk that you're going to live to 90 or 95 or beyond, that's pretty important. And the longer you wait, the higher your benefit will be and the better your long-term outcomes will be. Now, going back to Lucy's original question, she mentioned that they're retiring soon. But what if someone wanted to keep on working? Are there any interactions between your normal work income and Social Security income? The short answer here is yes, there's a negative interaction if you are younger than your full retirement age, but there's no negative interaction if you are at your full retirement age or older. So for that reason, it very rarely ever makes sense for someone to claim Social Security early if they are also still working. But it can make sense for someone to claim Social Security at full retirement age, even if they are still working. I think the next idea is I think using Social Security as a possible sequence risk buffer can be a great idea. Again, the idea is that you might start retirement without having claimed Social Security. Your plan is to live off your portfolio. But if the markets perform poorly and all of a sudden you realize that you're subject or you're exposed to some sequence risk because of that poor performance, what do you want to do in that situation? Well, in a perfect world, you would give your portfolio time to recover. You would lessen your withdrawals in order to leave more money in your portfolio to recover. How do you lessen your withdrawals? Of course, you can cut out spending. You can be flexible, like we mentioned a few minutes ago. You can also turn on Social Security. And boom, right there, you say, oh, we have an extra $3,000 a month coming in. That's $3,000 a month that doesn't have to come out of my portfolio. And that really does kind of dampen or buffer your risk against a sequence of return risk. And last, I'd consider some taxability concerns. So generally, claiming Social Security will reduce your ability to do smart tax planning. And it's certainly not the end of the world, but it is a secondary cost worth considering. In a perfect world, you would leave your options open to do smart tax planning. And the more income coming in, usually the fewer opportunities you have. And Social Security does count as income. So in short, there aren't many situations where I'd recommend a married couple both collect early as possible, Lucy. There might be one exception for being really open-minded, is that if both spouses have a really poor health history and a poor family health history, suggesting that both of them are likely to pass away before break-even age, I could see both of them claiming early. But either way, many, many different considerations when it comes to Social Security claiming. Most of those considerations suggest that at least one of the two spouses delay their claiming to 60 or 67. Here's a quick ad, and then we'll get back to the show. I send a free weekly email to thousands of readers that shares two simple things, just two. The first are my new articles and podcasts, so you'll never miss when I publish new content. And the second is my favorite financial content from other corners of the internet, so you can see what's been helping me the most.
But Jesse, I don't want another email.
I hear you. I make this newsletter short, sweet, and full of essential information, and readers enjoy that. About 85% of newsletter subscribers are engaging with the newsletter more than once a month. They're enjoying it, and you will too. You can subscribe for free on the homepage at bestinterest.blog, and you'll get a free PDF of my white paper titled The Step-by-Step Guide to Building Your Retirement Paycheck. That's right, a free weekly email that thousands of people like you are already reading, a free white paper to help you plan for retirement, and you can sign up for free at bestinterest.blog. And last, question for today from Nicole. Jesse, could you please do an AMA question about rebalancing your portfolio? I feel like different experts talk about doing it quarterly, doing it twice a year, doing it once a year. A lot of people talk about doing it based on the calendar in that way, but then other people talk about drift. For example, if your 60-40 portfolio drifts more than 5%, say to 65% stocks or to 55% stocks, then you rebalance it. How do you rebalance, Jesse, and why? Well, this is an awesome question, Nicole. And selfishly, I admit, I think it's awesome because it gives me a chance to really to flesh out some of my personal thoughts on something I've always had a feeling for in the back of my mind. I've never really gotten it out on paper. And truthfully, I've never dug into any sort of like alternative view or what researchers have to say. So all of a sudden now, through answering this question, I feel like I've really kind of solidified my own opinion on it. So it's just a win-win. So listeners, if you're not familiar with rebalancing, Nicole described it pretty well in her question. So thank you, Nicole. The idea is that an investor might decide, okay, my portfolio should be 60% stocks and 40% bonds. Okay, that's great. But as the value of that investor's stocks and bonds change over time, their original 60-40 allocation is going to change too. And the act of rebalancing is that investor deciding to bring the portfolio back to 60-40. So the question is, when should that happen? But first, I think a good place to start this answer is, why do we need to rebalance in the first place? Well, it's pretty simple. We do need to rebalance to ensure that our portfolio has the proper amount of risk and so that our portfolio meets the needs of our financial plan. We do not need to rebalance because that's the way to improve our long-term returns. So I'll say that again. We do not and should not assume that rebalancing will lead to better long-term returns. It might, but it might not. Increasing your returns is not one of the reasons to rebalance. So the reason, as I said a minute ago, is to make sure that your portfolio is still doing what you need it to do. It still has the right amount of risk in it. It still has the right amount of potential growth in it to meet your long-term needs. It's all about meeting your long-term financial plan. Or another thing is, I've talked about it here before, I usually look at everyone's portfolio through some sort of asset liability matching lens. And we want to make sure that everyone's portfolio has the right amount of assets to meet their short-term needs, their midterm needs, their long-term needs. So sometimes we need to rebalance to ensure we're doing that. And so what happens if you don't rebalance? Well, not rebalancing a portfolio will cause it to drift from its original target allocation, perhaps resulting in these unintended concentrations in your top performing assets, often stocks, which brings increased vulnerability to market downturns. And so while the lack of rebalancing may allow for higher returns during bull markets, it can lead to bigger losses during bear markets. So with that preamble, let's now answer the question, how often should you be rebalancing? So first and foremost, you can and should consider using your normal portfolio activities to more easily rebalance, meaning every single portfolio has some dividends coming in or some interest, some new contributions going into your accounts or some withdrawals coming out of your accounts, right? Money is already moving in and out of your accounts and in and out of your portfolio. So you can and probably should use that money as part of your rebalancing strategy anyway. If you're contributing $1,000 a month into a taxable brokerage account and that account currently has too many stocks in it, well, maybe you decide to have all 1,000 of your new 1,000 per month going only into bonds for a few months. You can rebalance that way. You don't need to sell your stocks to rebalance. Instead, you just use the new deposits. Similarly, you could choose to turn off dividend reinvestment for a while and use all those portfolio income sources to only go into one specific asset to achieve some rebalancing over time. But oftentimes, doing something like that isn't actually enough. You need to take some action above and beyond that to achieve rebalancing. And as Nicole mentioned in her question, the two most popular styles of rebalancing are time-based, once a quarter, twice a year, once a year, something like that, and then drift-based or threshold-based. You rebalance when your assets get 5% out of whack or 10% out of whack, or you rebalance when a particular allocation is 25% different when it started than when it started. If you have a 5% allocation to small cap value and that 5% goes down to 3%, well, that's a 40% change. So anyway, you can have some thresholds set there. Now, strictly speaking, and kind of in theory, a drift or threshold strategy makes a lot more sense because you're rebalancing based on the characteristics of the portfolio itself. The portfolio and its risk are out of whack. That's a great reason to rebalance. A calendar-based strategy, on the other hand, might dictate rebalancing when it's really not needed. Like, okay, it's October again. Well, what does October have anything to do with your portfolio? It's arbitrary, is my point. But the problem, and this problem exists with any rebalancing strategy, is to consider the costs of doing so. There aren't that many trading costs these days, which is a good thing, but you still ought to be aware of trading costs. They do exist. Some of the mutual funds you own might have a trading cost associated with them. Taxes are another cost, at least inside of a taxable account. And then your time is another cost, even though, sure, that's a bit subjective. Some of you, it might be really easy for you to rebalance because you're simple portfolio and you're pretty good at the math. And for others of you, it might be a real chore to rebalance. But the point is, the more you rebalance, the more costs you might be incurring. So if your threshold rebalancing strategy has you making trades every single month, is that really better than a calendar-based strategy that recommends you do it once a year? So that's what a Vanguard research team wanted to look into, and they published a paper in 2022, I'll link it here in the show notes, that attempted to answer those kind of questions. They tested all sorts of various rebalancing strategies for different portfolios, and they concluded that for just about any portfolio allocation, the optimal rebalancing strategy is either once per year or once per year only if your target allocation is more than 1% out of whack. And those two conclusions, they're basically the same thing in my opinion. So anyway, the whole point is it's once a year. The optimal portfolio rebalancing strategy is once a year. They looked at other time periods too. They found that daily rebalancing is the worst thing you could possibly do. But the next worst thing is never rebalancing at all. And then if we're going from worst to best, then comes weekly, monthly, bi-monthly, and quarterly. So the point there is that doing rebalancing too often, especially if it has some legitimate trading costs to it, is more detrimental, and just rebalancing once a year was their optimal solution. So how do we actually execute that? Well, I think we still want our routine portfolio activities, again, the dividends and the interests, the deposits and the withdrawals, we still want those routine activities to take rebalancing into account. If our portfolio is drifting, there's nothing wrong with using those activities to bring the allocation back in line. And I guess the reason why I say that is because those activities are happening anyway. There's no additional cost to them because they're happening anyway. You're playing with house money is the way to think about it. So you might as well rebalance if you're playing with house money. But beyond those routine activities, we want to set a once yearly reminder to rebalance. And candidly, I think that once yearly reminder can serve as a time when you revisit your entire financial plan if you want to, ensuring that the conclusions you reached 12 months ago are still valid today. You can revisit your allocation itself to ensure it's still the right allocation for what your financial plan needs. And then, of course, you can execute whatever trades are required to bring your portfolio back into line. I think that's a pretty simple solution, possibly much simpler than some of the rebalancing advice you see online, but it's certainly not sitting back and doing nothing. So Nicole, thank you for the question, and listeners, thank you for the awesome questions today. I hope this convinced you that financial planning can be pretty simple, but at the same time, there comes a point where we have to say, we can't be simpler than that. Thank you as always for sending in your awesome Ask Me Anything questions. You can send future questions to jesse@bestinterest.blog. I look forward to reading your emails, and thank you once again for listening to Personal Finance for Long-Term Investors.
Thanks for tuning in to this episode of Personal Finance for Long-Term Investors. If you have a question for Jesse to answer on a future episode, send him an email over at his blog, The Best Interest. His email address is jesse@bestinterest.blog. Again, that's jesse@bestinterest.blog. Did you enjoy the show? Subscribe, rate, and review the podcast wherever you listen. This helps others find the show and invest in knowledge themselves. And we really appreciate it. We'll catch you on the next episode of Personal Finance for Long-Term Investors. Personal Finance for Long-Term Investors is a personal podcast meant for education and entertainment. It should not be taken as financial advice, and it's not prescriptive of your financial situation.